So today I'm going to talk about micropensions, and I've been kind of nervous to present here because I've moved to the US when I was 12, and normally I present this in US schools, and I'm considered the India expert, which I know is absolutely not true here. So I look forward to all your corrections and comments. So this paper grew out of a hypothetical field experiment that I did about 2 years ago, and I'm going to show you some results on that. Yeah. So I'll explain. So exactly on that note, this is a very early stage paper. So just to give you some background, this paper was done as the foundation for what will hopefully be future field experiments. Some of those have already been funded. So what I'd really like to get today is lots of comments on how to translate some of these findings to a good experiment. So the topic is on micropensions. I won't spend too much time on motivation, but basically this is an important topic for the world's poor, and really everybody, because life expectancy is increasing and fertility is decreasing. Okay, so broadly, these include some expected forecasts. And I'll just jump to this. The poor stand to be especially vulnerable in old age, not just because of these increasing life expectancies and reduced fertility, but also, particularly in places like India, there's been a lot of reliance traditionally on joint families and on children for providing support. So I think Vimal had said that's like the crude form of insurance, right, for old age. And that has been breaking down slowly, especially in many of the rural areas. And when children migrate to cities or to other places, the remittances that they send home do not fully offset the amount of care that they would have provided had they lived at home. I realize I'm talking very fast. I started late, so just let me know if I'm talking too fast. And in the context of the overall policy scheme, there's limited poverty alleviation programs, and there's few ways to accumulate assets in the long term. So some of this has already been discussed today, but traditionally, people typically save via land, livestock, small bits of gold, things like that. And so there is a scope for a new product to come in and replace some of these other forms of saving. And so what micropensions are, I'll define the actual product shortly, although we've heard about it a bit today. Basically, it's targeted to low-income informal sector workers and is a savings plan in which people can put in small amounts of money frequently to save for old age. It addresses primarily the longevity and investment risks. The foundations also try to advertise the inflation risk, but really the investments are not inflation adjusted. So we'll get to that shortly. And in terms of history, micropensions were introduced in 2002 by the Grameen Bank. So right now, I think it's still around 7 to 8 million have been enrolled and stayed enrolled in India. Micropensions have been tried in other places like Peru, Brazil, South Africa, Ghana, and it's had mixed success as measured by enrollment. And typically, it follows a partner-agent model, and that means that the households, like typically there's a microfinance institution that will go door to door to the poor households and say, okay, would you like to buy this micropension? They may say yes, and if they say yes, then that microfinance institution or whichever kind of distributor will then collect that money, and that money is then deposited in a fund, and that fund invests the money, and then the money is then returned back to the households at time of maturity via these microfinance institutions or other distributors. And so there's a lot of literature on household saving. I mean, broadly, this says that savings by the poor can be large relative to their income and be sustained. In particular, with microinsurance, there's been some work on what predicts engagement with microinsurance. So for example, price, financial literacy, risk preferences, trust issues, for example, in government or the bank, and so forth. One paper, and many papers that I became aware of after coming here, my discussant, Renuka and Susan, have a paper just published in Journal of Development Studies, also on informal sector participation in a defined pension system. So this is certainly something that I hope Renuka will talk about in her discussion. And so again, I don't hope we need to motivate this more, but the aging issue is very real and very big, and it was a forefront issue at Davos this year. And so now I'll just skip to the kind of the overall market. So India's pension market looks a bit like this, where most people are in the excluded worker area, right? So most people do not have any form of a formal pension system. So 90% of people are in the bucket on the right-hand side. And so the people who are targeted by micropension products are really these informal savers and lifetime poor informal savers, as they're called. And so this is, altogether about 85% of the population. And the World Bank estimates that only 5% of these households are actually saving for old age in a meaningful way, and that the untapped saving potential is over $110 billion. So this is actually the product. So I'm just going to spend a bit of time on this. So the way that the product works, and the minimum age is actually 30. In some places it's 35, but it's the minimum age is 30. So you can start putting in money on a monthly, yearly basis at age 30. And then that money is invested by the government. Typically it's 60% bonds, 40% stocks. I think it's maybe 85%. It's maybe 85% bonds, 15% stocks. But regardless, the money is invested. And for the first 1,000 rupees that the household decides to put in the micropension product in the first year, the government matches that at 100% rate. So if a household puts in 1,000 rupees, they really have 2,000 rupees in their account. And then the way that it's structured is from age 30 to 60, 20% of the amount deposited can be withdrawn before maturity, which is at age 60. And so in the payout phase, it's a bit complicated, right? So we can understand that just for us, it takes a couple minutes. You can imagine for people who are less used to making these decisions, it's a pretty complicated product still. The payout phase, you can basically get however much you put in. You can get that back in a monthly fashion until the money runs out. Or you can take out at one time a 40%, and then the rest, 60%, will be given out in a monthly fashion. And then any of the unused funds go to your family. So for example, if you don't live long enough to get the money, or if you just decided not to take it. And so the question that I ask in this paper is, well, how do key features of the micropension product affect demand? And so the reason this set of questions were interesting is that this project was done in collaboration with Arvind Kumar at the Ministry of Finance. And at the time, they were really thinking about how to change the micropension product. And these were the key kind of components of the product that seemed eligible for change. So the way that I'm going to measure demand is household willingness to take up the product, and then their expression of how much they would be willing to contribute on a yearly basis. And the things that I will test in terms of the features of the product are the eligibility age, the options for lump sum withdrawal, and the government match rate. And then finally, I'll also look at some things along demographics, in particular assets and human capital and how those affect demand. So I'll get to those in the regressions. So study location was in Uttar Pradesh. In the US, they like knowing this is where the Taj Mahal is. It gives people a frame of reference. But basically, this was the 700 households in the study are drawn from 2 districts and 15 villages. And all of them are below poverty line households, meaning that their monthly consumption per capita is below 1,000 rupees. And they're all under age 60, meaning that they're actually eligible to participate in the product. And so this is the experimental design. So I'll leave this up for a minute. But basically what happened was there was a project being done in conjunction that wanted to look at a bundled life, health, and pension product. And so for that product, these anchors were really important. So what happened was that, okay, each household was randomized into one of 2 groups. So if you're in the first group on top, you received first this long household survey on all kinds of things, like how many kids you have, all your consumption on food, electricity, and so forth, your loans, all those different things. Then you were told about the micropension product, and you were given a suggested annual contribution amount. So you were told that, well, you could put in 230 rupees, you could put in 550 rupees, or you could put in 800 rupees. It was just an informal kind of suggested amount that was put to the household. And then finally, the households were asked about their willingness to take up or contribute to this product. First, and always first, they were asked about their interest in the baseline product, so the product as it's currently on offer, and then on different variations of that, which I'll explain. And if you're in group 2, you first heard, so basically if you're in the bottom half, you were first told about the micropension product, and you were told that, well, you could some suggested amount for how much to contribute. Then you were told, given this huge, long survey, and then after that, you were still asked questions about the micropension product participation. And so these are the experimental variants. I'll just show all three at a time. So basically, the baseline, which is the first column, this is the product as it's currently on offer. So here, the eligibility age is 60. The match rate for the first 1,000 rupees is 100%. And the allowable amount of lump sum early withdrawal before age 60 is 20%. If you were in group 1, you were then asked, after asked about the baseline product, you were asked, well, what if the eligibility age was 55 instead of 60? And then later they were asked, okay, well now think back to the normal baseline product, and what if the match rate was 50% instead of 100%? And finally, finally they were asked, okay, think back to your baseline product. What if there was no lump sum withdrawal at all, as opposed to 20%? And then similarly in group 2, they were asked kind of somewhat the opposite questions. What if the withdrawal age was 65 and not 60? What if the match rate was 150% and not 100%? And what if there was full amount of lump sum withdrawal? And so part of the reason these extremes were tested was because the sample size is really small, right? So this gives us some power to detect some differences. So I hope this is clear. So in the baseline, everybody gets asked about this combination of products. And then one at a time, people are asked about the changes in age, match rate, or lump sum withdrawal. And these are kind of provided to the household in a randomized fashion. And so if you chose to read the paper, these are what I call them in the paper, this 1B, 2B, and so forth. And so what I find first is that the households are randomized into 2 groups. First do a randomization check. Basically, everything seems to be roughly equal among the 2 groups. I do have more farmers and more savers in one group than the other, but the differences are quite minor. This is the same randomization check continued. All this is meant to show is that the randomization worked, right? So that the 2 groups are comparable. And then this is really what I get to. So this is what, so what I find is that when households are asked at baseline about the whether or not they would like to take up this product, 80% of them say that they would. Right? So we all know this is a hypothetical service. This is clearly an overestimate. Research suggests that the overestimate is typically by around 30%, so it's probably more like 60% or something like that would like to engage in the product. Renika, you can tell us maybe from your studies what the actual take-up rates are. But what I was interested here is in knowing, well, what are the differences between the different variants? So are the differences in take-up between the variants, and also what is the baseline interest? And to give you some perspective on the field when they were asked about these questions, the people that went door to door and asked these questions were actual LIC agents, Life Insurance Corporation of India agents, who generally are very involved in the micropension products. So households did take this reasonably seriously. So they did spend a full hour with the person coming door to door, and they did answer these questions. Like they took time and answered the questions. And so the results are somewhat mixed. I mean, obviously these are descriptive statistics. I'll show you regressions next. But 80% express interest in the baseline. And then even though the next options come in a randomized order, people seem to dislike almost all of them, except, of course, the one with the higher match, which is the second to last one. And so you do see that if the match rate is 150% instead of 100%, that people do appear to prefer that option, at least in the descriptive statistics. And so basically what this shows is that when eligibility is 55 instead of 60, or if there's a lower match rate, things like that, people appear to be liking the product a bit less. But I'll show you the regression results so that you can see these after controlling for other things. And annual willingness to contribute looks quite similar. It's about 1,000 rupees at the baseline, and then kind of hovers around, has the same sort of pattern as the take-up. So people, for example, in the higher match rate conditions seem to want to put in more rupees per year than in the other conditions. And this is just showing that there's a strong relationship between the amount that households already have in formal savings and their desired amount of annual contribution, which suggests that the way in which households are formally saving right now may actually be substituted with micropension products, right? So it looks very similar, the pattern. And we tested this formally, and we found that it seems that people would like to substitute some of their formal saving in banks right now with pension products. So what I do in the regression is I run two types of regressions. One is just looking at the outcome being take-up or willingness to contribute, that's in rupees, as a function of the experimental variant. So this is like which frame you got, like 150% match or early eligibility, whatever it was. And then controlling for a bunch of demographics, some experimental controls, like, for example, whether the survey was done before or after the pension product was mentioned, and the anchors. And then the second type of regression that I did was just looking at the effect of the experimental variance and then putting in a fixed effect for the household. So that fixed effect takes care of really everything going on with the household, not just what I observe in the covariates. And so this is the first kind of set of results to focus on the experimental variance. What I find is that compared to the baseline product, which is the reference category, that people, when they're shown the early eligibility frame, so when you can take money out at age 55 versus 60, people seem to like that a little bit less. People seem to like the late eligibility a lot less. The lower match obviously is liked less. The higher match is not significant in the increased desire. And that's also sort of interesting in that it shows that the baseline amount that people say that they might contribute might actually just be an upper bound, right? Like they're not going to put in more than 1,000 rupees, even if it's a higher match. So the minister found that one very interesting. And then also people seem to dislike kind of deviations from this 20% withdrawal, but it's not really clear what's happening here. And then you see very similar patterns for the annual willingness to contribute. The effects are in rupees here. So I'll leave these for the paper if you're very interested. I'll focus on the take-up decisions, because it's really very analogous, the take-up and willingness to contribute outcomes. And so what I also do in the OLS is that it allows me to look at the effect of certain demographics on the same take-up. So what I find is that the older the individual is, the less willing he or she is to take up the product, which is consistent with what we might think, like older people are less willing to invest in pensions. Farmers appear to be more interested. Number of children is slightly negative. It's not so, I mean, again, the sample size is small, so it may not be capturing the full effect of some of these things, but it'd be sort of interesting to see if number of children indeed is a substitute for long-term saving products. And then finally, the last one, for the people who already have a savings account, they really seem to be very much significantly more interested in a consistent way in a formal pension product. And then again, similarly, you see the same patterns broadly for the willingness to contribute. And so then what I look at, just based on the field studies, like I said, again, this is very exploratory work. One of the things we found was that many of the women that were being interviewed for the pension product, the surveyor said that they were very scared that if they put money in, that then their husband would be able to take the money out beforehand, before they needed it for their own old age. So the concern was that the women are concerned about widowhood and old age, so they'd like to contribute money, but then they're worried that if they put in money that it could be taken out earlier than when they need it by their husband. So I looked at, and I won't show these results, but to test this, I interacted the effect of being female with the frames that show later eligibility or earlier eligibility, and I find that this is very weak evidence that women may be concerned about this empirically. The anchoring seems to have a pretty large effect in that when the surveyors mentioned the 550 or 800 rupee anchor versus the 230 rupee one, that annual willingness to contribute does go up by 5% and then 8%. So this might have some policy implication for how to actually market the product and frame it, like what should be the amount that's suggested to people. And then finally, just in terms of more motivation, I thought, again, as it's exploratory, I've been trying to think about what would be interesting to do in an actual field experiment. some of the things that people are concerned about is that children won't be around to care for them. Someone says, I thought my children could care for me, but they're also poor. I tell them to buy assets or save money for their old age. Funeral expenses appear to be some motivating factors. And then finally, the woman who says, I'm 12 years younger than my husband. I worry about growing old, and I buy some gold when I can, but it won't be enough. And I think this is something that, especially in India, is a prevalent issue where women tend to have a larger age gap with their husbands in rural areas, and then they do live longer. So the pension product as a role for women in old age seems to be very relevant. And then I'll just put this up here as a concluding remark where it seems that there's a lot of interest in this product, but there's really very little evidence on it. Like, there's no field experiment on micropensions yet. I think Renika's paper might be one of the first to be kind of formally in a journal on micropensions at all. And so it's a very exciting new product to be thinking about, especially with regard to old age security. And the amount that people are reporting that they'd be willing to save is actually not trivial, right? So it would give them about 30% of their old age consumption. So it's not a trivial amount. It seems that anchors and match rates might increase the willingness to contribute. And there's very kind of little evidence, and more evidence from other people's work, that households may value the commitment feature of the product. That the money is tied up until age 60, but it's not really clear that this is something that households value or not. And I think right now the policy discussion has been very much that people would like to put money away and have it all the way until 60, with some options to borrow against it early on. But until we really know how much they value it or what the ratio of lump sum withdrawal or borrowing should be, it's hard to design a good product. And finally, that's a fertile area for lots of future work. I think in particular the marketing part is very interesting. So the pension product, typically the agents are incentivized on this. Like, they're given, see lots of nodding going on, so maybe you've thought about this. So they are given typically 100 rupee, I think you were telling me, right? 100 rupee incentive for selling the product. And that's kind of interesting, right? Because it's not clear that many of these people should be having the product at all. So then if we incentivize it in a way to increase take-up, we might actually be making these households worse off. So I'm thinking about these different things now and would love your comments on it as I go forward with this work. So thank you.
And I must say, this is a topic very close to my heart. So I suppose most of my comments will be about what do we think about micropensions and what do we think about the distribution of these pension products as we go along. So from these results and from some of the results that we have in our paper too. So, let me start by saying at least what do we think are the big questions when it comes to micropensions in this country or in many other emerging market countries. So one is that how do we encourage accumulation of wealth to finance retirement consumption? And typically the problems in doing so are that you can't mandate employer contributions in this country. The transactions costs are very high. And as we know, there is a big problem of consumer protection when it comes to selling of finance, and this problem just gets exacerbated when you actually start selling products to low-income households. And then what do we do with the NPS Swawalamban scheme, which is the micropension scheme that you refer to going forward? One of the big questions that has emerged over the last 3-4 years of experience with the NPSS is what do we do with the matched contribution? And like you showed in your result, it seemed to be that the match rate really matters. And it seems to be that that is the critical decision that the government needs to make, because the match is going to expire in 2017. So we need to know whether we should continue with this matched co-contribution of rupees 1,000. Should we redesign it, or should we abandon it altogether? So there needs to be some measure of a cost-benefit analysis. So, in the micropension space, especially sitting in India, I think these are the two big questions on what do we do. So I'll just compare some of the results that you have with the paper that I have with Susan that's coming out in JDS in 2015 in January. So I'm quite surprised that about 80% of the people in your survey said that they are interested in this product. But when we look at administrative data and we look at the universe of customers, and that's about 300 300,000 customers, when we last studied this database, about 10 to 12% of them actually chose to contribute to the pensions product. Okay, so the take up in reality in the universe of KGFS customers was quite low, much lower than the 80% of hypothetical take up. Also, another thing that struck me about the paper and the willingness to contribute was that people said that they'd in the baseline scenario, they said that they'd contribute 1,000 rupees, but only 50% of the participants of these 10 to 12% had actually managed to put in 1,000 rupees in at least one financial year, which means that they did not get the government co-contribution for whatever years that they did not put in 1,000 rupees. So while there is this annual willingness to contribute talk, the conversation when it comes to the NPSs has become centered around the threshold of 1,000. So, do you put in more than 1,000 or do you put in less than 1,000? And that has become the frame of reference for every conversation on the NPSs. And I think that is a bit of a tragedy, but and that is the work that we need to do on analyzing the role of this threshold again. So from our results, we find that in the universe of our households, the relatively poor have a higher probability of participation, but amongst the participants, the relatively rich actually put in the 1,000 rupees. We also find that persistence has been improving over the years. So just because in the first 2 years, there only 20-30% people contributed, it doesn't mean that that's what it stayed. By the 4th year, persistence has certainly improved. Also, what was interesting was that if you didn't contribute 1,000 rupees in 1 year, it does not mean that you never came back to contribute. So we do see people coming in and out of those products, whether they get the co-contribution or not. Finally, there's a suggestion you make somewhere towards the end of the paper in your conclusion about the role of these multiple small value transactions that will help poor people save. But at least from the KGFS data, we find very limited evidence of that. And also, whatever field visits that I've done, people don't want to put in 100 rupees each time. They find it cumbersome. They don't want to go and walk up to the branch. They forget. So the only people who seem to get good persistence are people who can put in 1,000 rupees upfront and then forget about it for the full financial year. I mean, they may have been able to put in more, but because of that threshold, they don't think about anything beyond the 1,000 rupees. So I think that there needs to be a lot more study on this, how do you enable these multiple valued transactions over time, because I do think that that will improve the total contributions that you may have in your accounts. I have a few problems with some of the definitions and some of the target audience for the micropensions. So I don't understand what informal savers are. Also, to a large extent, if you're lifetime poor, your ability to contribute to a pension account is also going to be very limited. So really, the audience for the micropensions is actually maybe people who are just a little less than poor. And how do we define poor? Is it below poverty line? Is it above poverty line? So I think that group is very heterogeneous, because this matters for who we think the target audience for this particular product is. And this whole notion of informal. So a contractual academic like me at the Indian Statistical Institute is an informal sector worker, because I am not part of the EPFO, I am not part of the NPS, right? So by many definitions, I'm the informal sector, but I'm certainly not an audience for the micropensions product. And I think that we need to be a little more careful in how we make these definitions. So let me come to what has become the central question in this micropensions debate, okay? And the central question has become, what do you do with this 1,000 rupee threshold, okay? And the match may not exist after March 2017. So should the match exist has also become a very important question in this debate. And all the other questions that are being varied, in asking people both about their take-up and about their willingness to contribute, given the design of the product, need to be should be asked in the context of this threshold. So for example, in many of these statistics, the annual willingness to contribute goes down below 1,000. Okay, but it also means that then they will not get the co-contribution amount of 1,000. So does that mean that they are willing to let go of that amount, or were they not thinking about the fact that they will lose that 1,000 rupees if some of the other features of the product change? So I think maybe if you brought in the role of that threshold when you asked all of these other questions, that would be very useful to the paper, because I think that's the way all of these conversations around NPSs have become framed. And, in terms of, I mean, I haven't mentioned this on the slides, but in terms of co-contribution as well, the other issue with the threshold is that while it's a 100% match, if you put in 1,000, if you put in 999, you don't get anything. Right? And so therefore the question really is that suppose I matched you equal percent, I mean 100% up to 1,000, would that change a lot of things? So somebody who can put in 700 rupees a year is probably better off than putting in nothing, even regardless of whether he or she gets the government contribution. But today the scheme is disincentivizing people who can't reach up to that 1,000 because it gives them nothing. Okay, so the question, I think, in terms of co-contributions, more than the higher match rate, what will be really interesting and useful is to ask whether instead of the ceiling, should it become the floor? Like, I mean, I'll give you a match up to 1,000, but even if you're putting in less than 1,000, I will give you a match to whatever it is that you're putting. And I think that's the central role of the threshold design that we need to ask ourselves. And finally, one of your results was that the saving account is positively correlated with take-up. That's interesting because in some of the fieldwork that, conversations that we've had in the field, it seemed, and I mean, this is anecdote, that people who had formal savings account were actually the ones putting in money in the NPSs. But this also raises questions around whether it's additional saving or is it just crowding out from somewhere else. And again, it has implications for what you do with the matched contribution. Because, I find that the NPSs is an expensive product, right? You're not only giving 1,000 rupees co-contribution for a very long period of time, you're also subsidizing the aggregators. So they are getting paid 100 rupees for sign up and 100 rupees for every person who manages to get to the 1,000 mark. So that's almost 200 rupees per customer. And that's really expensive. And should government be subsidizing that amount now, or should it just design a flat rate social security program like the IGNOAPS and, take this money and put it in a pension program? So I think those are the sorts of questions that that become very important in this space, especially when you start thinking about co-contributions and what people are doing with their savings once this NPS has been introduced. So, in conclusion, I think that this is a very important question and a part of a larger academic and policy literature on the design of pensions products for low-income countries. And I think that in this paper, if there could be some reorientation of the writing for the design of these co-contribution parameters and the thresholds for co-contributions, I think that would be a very valuable contribution to the literature. Thank you.
So we opened the.
Any idea about the returns this fund has generated now that it is there for last 2 years? Can we not create a reinforcement behavior because of the returns?
It has been about 8 to 9%.
Only that much?
Yeah, because what has happened is that about 85%.
You want to speak? Sit and speak in the mic, please.
So what seems to have happened is that almost more than 85% of the money has been invested in government bonds, and there is very little equity investment. And the returns have been similar to what I think civil servants get, and that has been about 8 to 9%.
Given the challenges these people have in saving, why can't that asset allocation be little more biased towards equity? Is it not necessary that
We
you
have
make
been
a
having
policy
that debate.
recommendation?
There exists a Deepak Parekh report which was on how NPS should do allocation, and
And also it is 50%, no?
no,
That changes according to age, and that is citizens of India who open an account are allowed that, except civil servants and NPSS people.
Yeah, so the recommendation is out there, and as Ajay mentioned, I think at some point that there are a lot of policy questions still evolving about the scheme, and hopefully we'll see some changes on that going forward. Raghu, you had a question.
Yeah, it's yours.
No, I was just wondering how you take care of peer effects. So, because one of the major problems you're going to have is you ask people hypothetically what you're going to do. It's very different from when everybody in the village is already doing this. And the second one was on the social welfare. It goes back a little bit to what Renika was saying. If I've got a pension, my kids are gonna say, well, my parents got a pension. Why would I want to give money to him? He can support himself, right? So from a societal point of view, it's also a worry there, right? It's really helping you.
So I have
Can I? Interjection. There are many, many gloomy things in the world. One of the more gloomy things in the world is a paper which I unfortunately cannot give you a precise citation to, that parents who annuitize more receive fewer visits from their children.
I had a small.
Rick and you, sir?
Yeah,
and
yeah.
No, first Rick, then you, and then Venki.
So when I was looking at your results, somehow it seems that the baseline, which presumably is presented first, seems to be more preferred relative to everything else. So when you tell them, okay, whatever, 60 years, blah, 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 and then you change it to anything, they seem to have a negative bias towards everything else that's presented after that. So I don't know if you want to do this, and if that is true, then everything has to be, all your results have to be sort of interpreted with that lens. For example, this 150% match, they don't like it too much more, but 50% match, they really hate it compared to 100%. I don't see why that's happening. So I don't know, if you were to run this again, then it would make sense to have different baseline to see whether there's a love for baseline kind of an effect going on there.
2 points. One is how many people are interested in a bundled product with insurance, and how many are interested in standalone in percentage? And second point is, in other places in the world, has there been any experience of longevity risk and how it will change the design of the product?
Yeah, no, mine was on the knowledge about this instrument itself. How well did they know about stocks and bonds, and whether the fact, I think you had mentioned that people who had earlier savings ended up doing more of this. Maybe they were already exposed to the concept of risk in stocks and bonds. Maybe they're more likely to take such instruments. So.
Sure. So I can take these kind of in maybe backwards order. So with that question, typically the LIC agent just kind of gave them a parameter of return. So they typically said this 8 to 10% return. And unless, I mean, they were told the stocks and bonds thing, but I think that wasn't the emphasis. So so in later questions we found out most people don't know stocks, bonds, but they do understand the 8 to 9% average return. So that's certainly something that we can look into, like looking more at the knowledge of these different instruments and how that affects take up. With the bundled product, it was about 50% average in the hypothetical take up, and I think partly because it was just more expensive. With longevity risk, I think that's something certainly people are concerned about with defined contribution products, right? So people ask lots of questions like, if I put in this much for this many years, for how many years will I actually get payouts? And it tends to be for the average person investing at age like 35 to 60 that they'll get payouts for about 15 years. So that will take them to 75. So I'm not aware of lots of other products that are out there that are providing true annuities or something like that.
Just let me add, in our data and in the conversations that we've had, if you ask them what do you think you're going to get in retirement, the expectation is that I'll at least get a monthly pension of 1,000. So I don't know where that's coming from, but no matter what age you are, so we spoke to somebody who was 55 and would retire in 5 years, and she said, and she can't have started contributing, 4 years before was the earliest because that's when the scheme was introduced. So even she expected a monthly pension of 1,000.
Sure.
So, if you're talking about this is 1,000 rupees a year.
A year in contribution, yes.
Okay, so these people are very, very poor, right? Why are we giving them defined contribution? Makes no sense, right? Shouldn't it be defined benefit or something like? I mean, the idea that these people should contribute and subject to any kind of risk, and this thing, I don't get it.
So, I think that part of this answer is that the informal sector that the NPSS has targeted is very heterogeneous. So, if you look at the people that are contributing in our data set in Tanjavur or in Uttarakhand, for example, poverty, how poor are they? They're not as poor as people here, right? So in that sense, for those kinds of households, and considering their incomes are growing, it is plausible to expect them to contribute towards a pension product. Secondly, I think
No,
given
my question was about risk, right? A defined benefit, the implicit risk is being borne by the government or the taxpayer. Here, the risk is being borne, even if you go to equity, will be borne by. There's no point in saddling people who are expecting few 100,000 rupees into to any kind of risk. I mean, we should make up our mind. If you're going to tax people and give them some benefit, let's just give it to them. I mean, this whole anyway, yeah.
The only thing I'll add is just that the 1,000 rupees still, as I showed, it does, based on the consumption surveys, it does provide about 30% of old age consumption. So it's not a trivial amount. But you're right. I mean, I think to fund it probably just at a large scale is still very expensive, which is my guess for why defined benefit is still not very popular. But there.
I suppose, today in India we are looking at the expense of, from a fiscal perspective, the co-contribution amount and the subsidy that we give to the aggregators, vis-a-vis what it would take to fund, say, an IGN, the pension scheme that exists for people below poverty line. And I suppose those are the calculations that we need to make in terms of what does it cost to get these people to basic consumption levels.
So Bhagwan, now you know why they prefer gold.
Sure, and then, I can just answer the rest. There was some, so you had asked about the informal savers. I was just following the terminology from the World Bank, and they, so these were all below poverty line populations that I was showing, so you would have been excluded, but that's good to remind me. And then I think with the crowding out or saving, it does seem to be more of crowding out current saving from my data set, but I think that's an open question. Which may not be bad in a way if the new method of saving is better than, for example, saving it in gold or other forms, right? It's just a new technology. Certainly the hypothetical part is a huge weakness of this part, but like I said, this was very much a motivation piece to figure out, before we actually do a field experiment, we want to have some sense of what people might actually think. With this MFI, so we were working with SEWA, and so they tend to have about a little bit higher take-up. It's around 40 to 50% take-up, but they also do incentivize their agents quite a bit, so it's unclear how much is coming out of genuine demand versus kind of the pressure in the sales environment. And with the small value transactions, I think one thing that consistently people said in the surveys was that they have variable income over the year, and that they would like to be able to put in large amounts at some points and small amounts at other points. And I'm not, so I'll certainly fix the writing. And we're not able to say something about at what frequency the payments should be, but it seems that people on average would like to put in around 1,000 rupees in the year. And I think those were probably the...
I had one point on the design of the experiment. We did something very similar on the informal sector interest rates that they pay. And we found quite a bit of difference when we had a market research firm go and do it versus somebody like a LIC agent. And I think largely because of the trust deficit, the fact that they have dealt with this LIC insurer agent before gives them a little bit more confidence to even deal with this. But if you take a random guy going in and doing a survey, I think none of them would have taken any of these products. So I'm just assuming that there's a design.
I can't resist. I thought I would trust the LIC agent less.
No, but this is certainly a big part of it, and I think that's why SEWA's constituents also seem to take up at slightly higher rates, just because they've been around for so long and have such a solid relationship. As with the LIC people, at least it's a big company, so they think, and we did measure trust in institutions, I didn't go into it, but they seem to have a reasonably high level of trust in LIC and the banks, and so I imagine as that varies across areas, that take-up would also vary significantly.